Hello everyone, this is Alejandro Cremades, and today we're going to be talking about how to value your company. So essentially, valuing your company is super important. I mean, it's really all about making sure that you put the right price tag. So if you're looking to maybe seek some financing or maybe get your company acquired, you know that you have a valuation that is going to make sense and perhaps a valuation where the market is going to react positively. So with that being said, let's get into it. So in terms of the different methods that you're going to have the discounted cash flow, you're going to have the Chicago method, you're going to have the comparables in the market. And I think that this is a great one because essentially if you take a look and you see let's say your competitors that they have raised X, Y, and Z, then basically what you do is you put yourself in the middle. So for example, if we're talking about valuations that range between let's say 15 million to 30 million, basically you would just put yourself in the middle, let's say 25 million, and even if the investor is telling you that perhaps the price is a little bit expensive, you can say absolutely, but that is what the market is paying. So essentially it's very tough to negotiate against that. The other method that you're going to find is, again, the venture capital model, right? Which is really benchmarking on the potential returns that the business is going to be able to generate. Then you have the scorecard valuation method, which essentially is taking a look and adjusting to what the seed valuation is, such as also the region, the segment that the business is in, and certain factors that are really going to play a big part in getting that valuation. The last one is the risk factor summation, which essentially grabs 12 characteristics of the business, and then as a result of that, basically you come up with a valuation that you establish on your business. So when it comes to frameworks, for example, especially if you're looking to raise money for a tech-enabled company, hypergrowth business, there is different frameworks that you can use to really guide you in the journey really of really establishing a price tag in your business. So for example, at a pre-seed basically financing level where you are taking in money for the very first time, obviously investors are not expecting revenues, and typically what you're raising is between 200 all the way to 500,000. Typically the valuation that you're looking at is around 1 to 2 million pre-money. Then you have the seed level. At this point, really what you're going after is perhaps $500,000 or more. And essentially what the investor is going to be expecting is that you are generating anywhere between $0 to $50,000 in revenue. And here essentially the type of valuation that you're looking at, especially if you're in the US, in startup hubs like the East Coast or the West Coast, like New York or San Francisco, you're going to be looking at potentially a valuation that is going to be around 2.5 million. When you're at a Series A level, essentially what you're raising is anywhere between 3 to all the way up, it can go to 15 million. The types of valuations that you're going to be seeing is anywhere from maybe 15 all the way, it can go all the way up to 40 million. But essentially here, the types of revenues that the investors are going to expect is anywhere between 100,000 all the way up to $250,000. When you're at a Series B level, you're raising anywhere between 20 million and it can go all the way up to 50 million. The types of valuations that you're looking at can go all the way up to 100 million and in some instances even farther than 100 million. At this stage in the game, the investor is going to expect to see anywhere between $250,000 in revenue all the way up to $1 million, and this is on a monthly basis. And again, on all the previous frameworks that I talked about, remember that the revenue is always per month. Now there's a big difference between pre-money valuation and post-money valuation. Pre-money valuation at the end of the day is the value that has been established by the investors that are coming in your round right now. And essentially, if for example, if it's 20 million pre-money valuation and they are investing, for example, 5 million, the post-money valuation essentially is 25 million. So pre-money valuation is before the money comes in and post-money valuation is after the money has been injected. So with that being said, hopefully this video was helpful as you're looking to establish the valuation of your business. Don't forget to hit the like button underneath. Then also take a look at subscribing so that you don't miss out on any of the videos that we're going to be rolling out. And then also make sure that you leave a comment. And then don't forget as well to check out the fundraising training, which is the program where we help all the way from A to C to founders with everything related to fundraising. Live Q&As, also agreements, templates, a community of founders helping each other all around the world, you name it. And I think it could be of tremendous value to you. So thank you so much for watching.